Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories within corporate filings. Alright, grab your favourite snack because Mondelez International is back with their 2025 annual report. And let me tell you, there are some interesting movements in their financial world this year. We are diving deep into Mondelez International Incorporated's 2025 annual report filed with the CC. Think of this as the company's yearly check. Up a detailed look at their financial health, their risks, and their plans for the future. First, let us glance at how Mondelez has been doing over the last 5 years compared to the S&P 500 and their own peer group. It paints a picture, but honestly, it is the very latest numbers that tell the real story. Now, Mondelez is buying back its own stock, a common move to return value to shareholders. In October of 2025, they bought back about 17,533 shares. Then in November, that number jumped significantly to over 1.7 million shares, and in December, it ballooned to over 7.2 million shares. This indicates a strong confidence from the company in its own stock value. This buying spree shows they believe their shares are worth investing in. Now let's talk about what is happening in the real world that affects Mondelez. They are facing higher costs for almost everything, especially raw materials. Things like cocoa, wheat, and dairy, it all adds up. They tried to offset this by raising prices on some of their products, but as you can imagine, that has made some consumers buy less. This is known as pricing elasticity, and it is affecting their sales, particularly in Europe and the United States. The situation in Ukraine continues to be a factor impacting their business operations and overall finances. Although they have a presence in Russia, which is 3.7% of their revenue, they are navigating a complex geopolitical landscape. Let's look at the money matters, the actual dollars and cents. Their net revenues in 2025 hit roughly $38.5 billion, an increase of about 5.8%. However, their so-called organic net revenue, which strips out the effects of currency changes and acquisitions, actually grew about 4.3% to $37.9 billion. This small but important difference shows that while the overall numbers might look good, currency fluctuations and acquisitions are playing a notable role. Digging into the details of this organic growth, over 7% came from emerging markets, showing a resilience or perhaps a higher need for snacks in those regions, while developed markets saw a slower 2.5% growth. Now let's talk profits. Operating income took a pretty big hit, decreasing by 44.1% to $3.5 billion. But here is where it gets interesting. Their adjusted operating income, which is a way the company tries to present a clearer view of their ongoing business performance, decreased by a smaller 13.9% to about $5.1 billion. This adjusted number is important because it removes certain one-off costs like those big mark-to-market losses on derivatives. This drop in profit is largely thanks to those higher input costs as we discussed earlier. These were up significantly, especially for cocoa. Even though they raised prices, that was not enough to fully cover the spiraling costs of making their products. On top of that, their sales volumes actually dropped in Europe, Latin America, and EMEA regions, which indicates that consumers are indeed cutting back on buying more expensive snacks. Looking at their regional performance, the Europe segment saw a decent revenue increase of nearly 13%, mainly driven by price hikes, but their operating income in Europe dropped by a staggering 12%. North America also experienced a revenue dip of 2.1%, and their operating income plummeted by over 23%. This suggests that even with price increases, they are struggling to maintain profitability in these key markets. Let's quickly touch on cash flow. They generated $4.5 billion from operations, but that is down from the previous year. Investing activities used up over $1.1 billion. Financing activities saw a large outflow of nearly $2.8 billion, mostly due to debt repayments and share repurchases. Their total debt increased to $21.2 billion. The company's debt to capitalization ratio is now 0.45, indicating a significant but possibly manageable level of leverage. A major part of their balance sheet is tied up in intangible assets like brand names totaling nearly $19 billion. They had to take new impairment charges on some of their brands in 2025, which means some of those brands are not performing as well as they hoped. This affects their reported profits and shows that not all brands are keeping up with expectations. Their pension plans show a net asset of $767 million, but this comes after significant settlement losses in 2025 related to pension buyouts, costing them hundreds of millions of dollars. It seems they are tidying up some old financial obligations, and it is coming at a high price. Looking at employee compensation, their stock plans are quite substantial. They granted a significant number of stock options and units to their employees, showing a focus on retaining talent but also a considerable expense. Mondelez uses a lot of derivatives to manage financial risks, and these instruments can create big swings in reported value. In 2025, they had massive mark-to-market losses on these derivatives, which heavily impacted their reported operating income and earnings per share. While these are often paper losses, they show the sensitivity of their financial results to market fluctuations. So what is the overall picture here? Mondelez is pushing hard with price increases to combat rising costs, and it is impacting consumer demand. Their European and North American operations are showing signs of strain with falling profits despite revenue growth. They are actively managing their debt and pension obligations, which is a necessary but costly endeavour. The big question is whether their strategy to lead the future of snacking can truly overcome these significant cost pressures and shifting consumer behaviours. While they have strong brands and a global reach, the current financial performance raises some concerns about their ability to grow profitably in the near term. Alright, that is our breakdown of Mondelez International's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord community linked in the description below. Thanks for watching. See you next time.